Hello and welcome to this energy investment analysis lesson on the time value of money. So we're going to cover all of these learning objectives today, and as with all of the energy investment analysis lessons, make sure to look at the description for a link to all of these slides, which includes links to other things as well. So we're going to differentiate between inflation and time value of money. We're going to define terms associated with the time value of money, and calculate the effect of compound interest and compound interest working in reverse, which we will call discounting, and discuss how discount rate can affect the time value of money, and calculate the present value and net present value in Excel. So let's get started. So we started off in this course talking about these questions, about which would you pick and why. And let's just look at number one. Would you pick $100 now or $100 a year from now? And most people get this answer right, that you would want $100 now because of two separate reasons. But let's dive into this a little bit more. These answers are all going to be based on the time value of money. So, and if we think about this from our cash flow, is that our cash flows far out in the years 12 or 18 or 20 are going to be affected by this time value of money. And we have to think about how to take that into account. Now, the first thing is, a lot of people get confused between time value of money and inflation. So I do want you to take a little break from my video and watch this Khan Academy video on what inflation is. And we're going to talk more about inflation next time, but this will give you a little bit of an idea of the difference between inflation and time value of money. So take a second and watch this video by clicking that link, and then come back to my video. Okay, you're back. So hopefully by the previous video, you found that inflation is the increase in the cost of our total basket of goods. And that is something very different than time value of money. What time value of money is that it's the fact that if you put money in a bank account or invest it in something else, you can earn interest on the money. So those are two very different things. We need to treat them differently. So in this lesson, we'll be focusing just on the time value of money and ignoring inflation. We'll come back to inflation in future lessons. So let's start with a little bit of just compound interest, because we're talking about putting money in a savings account. So let's pretend like we do that. So let's say we put $200 in a bank account. How much do you have in the following situations? If you have an annual interest rate of 7%, an annual interest rate of 3.5%. So think about this and try to calculate it on your own, and then we'll go over the answers. Okay, so now let's look at a graph of these two situations. The blue line is the money in your account with 3.5% interest, and the red line is your money in the account with 7% interest. So you can see why they start very similarly, and even at year 9 or 10, they're not much different. 30, 40, 50 years in the future, they're very different. Let's look at the answer for 50 years. With an annual interest rate of 7% after 50 years, you would have $5,506. With 3.5%, you'd have $1,079. This is actually very similar to what we did before with the solar power degradation example, except in this case, the rate is positive instead of negative. You can go ahead and click this sheet, this Google Sheet, to see the answers to this problem and how I calculated them. But the basics is that we use this compound interest equation, that the future value of something that I put in a bank account is equal to the present value, so how much I'm putting in now, in our case it was $200, times 1 plus r, where r is the interest rate, to the n power, and n is the number of time periods. The caveat with this equation is that both r and n have to be over the same time period. So if r is an annual interest rate, we need to make sure that n is the number of years. If r is a monthly interest rate, we need to make sure that n is the number of months. So make sure to keep that into account when doing your calculations. So now we want to think about this situation though. This is a similar problem, but a little bit different, and I say it's compound interest in reverse. So let's say and we'll just say after 10 years, I have $200 in a bank account. And how much would I have started with different interest rates? So let's think about a few different cases in this case. If I have an annual interest rate of 7%, and after 1 year I had $200, or after 10 years, or after 50 years, how much would I start with the account? So again, I'll give you the answers here. If I had a 7% interest rate, I'd only have to put $6.79 in to an account today for it to grow to $200 in 50 years. If it was 3.5%, I'd have to put that in that same account $35.81. And another thing to notice about interest is that it's not linear. All that means is that we can't just say that today I'd have to put in, if I have my interest rate, I have to put in half of or double the amount. So you would think intuitively that if a rate of 7%, if I only put in 6.79 today, maybe if I have my rate to 3.5, I'd only have to put in double that amount to get that $200 after 50 years. But that's not the case. Again, you can see this spreadsheet for the answers, but I'm also going to show you the graph. So again, they start out very similar, and in year one, you have to put in almost $200 to get $200 in a certain number of years. And then in year 10, it drops pretty low. And again, it drops, you keep going down and down and down to a very small amount that you'd have to put in today to actually get $200 in 50 years. So this is actually called discounting. And what that means is instead of going to the future and seeing what your future value would be, if you put in a certain amount of money, it's seeing how much those future values are worth today. So it's finding the present value if you're given the future value. And you can see we've just sort of reversed the formula that we had before in a previous slide by dividing both sides by 1 plus d to the n. So in this case, it's all the same variables except for we changed the r to a d. And this is usually done in these types of calculations because the d is a very specific interest rate. It's called the discount rate. And we'll talk a little bit about that more on the next slide. So it has the same caveats with the interest rate and time period, so make sure to keep that into account. So now let's get back to these questions. Let's start with number 1. So what would you pick, $100 now or $100 a year from now? So start by finding the present value for each case, and whichever has the highest present value would be the one you should pick. So if $100 is now, that is the present value. The other thing you could think about is that now is 0 years from now. So your denominator is raised to the 0 power, and anything raised to the 0 power is 1. So it's just 100 divided by 1. So that's the answer for part A. For part B, you can see the equation filled in there, where present value equals the future value, which is 100, divided by 1 plus 7%, which is our discount rate, to the 1 power because it's 1 year from now. So it's 93. The present value of $100 a year from now is $93.46. So again, the other way of saying that is that if I put $93.46 in a savings account today that earns 7% interest, it would grow to $100 a year from now. And that would be, that's why we compare things this way. So the present value, I would rather have $100 now. And that's intuitive. And that's what most of you answered. So let's think about this same thing. This is actually the same question, $100 now and $100 a year ago. The only difference is that a year ago is what I'm going to make my present. So part B, the present value is going to be $100, and part A, the present value is going to be that $93.46. So in this case, we would choose B because the present value is higher. Okay, so now let's look at, would I rather have $110 now or $100 a year from now? And $100 a year from now I've already done, which is that $93.46. And part A is again now, so I don't need to do anything. It's $110. So we would choose A. So number 4 is the really tricky one. So why is this one tricky? Well, again, $100 now has a present value of $100. But $110 a year from now turns out to be a present value of $102. So in this special case of an interest rate of 7%, I would choose part B. But if our discount rate was greater than 10%, you would take $100 now. That makes sense intuitively, because what that says is that if I can make 10% or more, if I can make more than 10%, then a year from now, I would have more than $110 in my bank account. So this hopefully shows you how the discount rate can really affect your decision. So these are the answers to this. And again, you can see the sheet for the answers. But let's talk about the discount rate. In the NIST manual, the discount rate suggestion is 3%. So if you're not sure what to use, if I give a default value, use 3% in this class. But in general, a discount rate is what you or your organization could make on a safe investment. So put another way, you can think using a discount rate. Think of using a discount rate as using a comparison to a safe investment. So if you're going for energy efficiency or solar, you could spend that money on upgrades to your home or your business for energy efficiency or solar, or you could put that money in a safe investment and earn a 3% return or whatever your discount rate is. And I just wanted to put a little note in here is that some businesses or companies or people, their discount rates can be dramatically higher than 3%, greater than 100% even in some situations. So you really want to get a good handle on what a discount rate is for a given company or organization when you're doing an energy audit or solar power project. So one other term for you is once you've found all these present values, if you have a bunch of different present values, which you would if you're doing a cash flow, the net present value is simply the sum of all the present values. And this is useful when you have a cash flow for multiple years, which happens a lot in the energy field. So I'm not going to go over it in depth, but you should, before you start doing these calculations in Excel, look at the light bulb cash flow diagram and how I calculate the present value and the net present value by clicking on this link. And that's all for this lesson. I hope you enjoyed.